Today, the silver market reaches a mechanical moment that cannot be ignored, delayed, or spun into narrative comfort. Today, every holder of a March silver futures contract must make a final decision: roll forward, close for cash, or stand and demand physical metal. There is no gray zone in between, and behind that simple procedural choice sits a structural imbalance that would dominate global headlines if most people understood the scale. March open interest represents approximately 230 million ounces of paper silver claims. COMEX registered inventory, the only silver legally available for immediate delivery, currently stands between 86 and 88 million ounces, 230 million ounces of contractual promises, 88 million ounces of vault metal. That is roughly 2.6 paper claims for every physical ounce that can actually be delivered. Before a single contract holder chooses to stand, the leverage is already visible. But the March contract is only one layer of exposure. Across all active COMEX silver contracts, total open interest sits at 131,496 contracts. Each contract represents 5,000 ounces. Multiply those numbers, and the result is approximately 657 million ounces of total paper exposure. 657 million ounces resting against 88 million ounces of registered supply. That is 7.5 paper claims for every 1 ounce of deliverable silver. If just 15% of total contract holders demanded delivery simultaneously, the registered category would not be sufficient. That is not dramatic language, that is arithmetic. The exchange functions because the majority of participants choose paper efficiency over physical settlement. If that preference shifts materially, the leverage compresses instantly. First Notice Day is not speculation. It is a scheduled exchange event that forces every open March contract into a binary outcome. The holder must either roll into a later delivery month, close the position for cash settlement, or stand and request physical metal. Rolling reduces immediate delivery pressure but keeps total exposure alive. It postpones the imbalance rather than resolving it. Closing removes a paper claim entirely, but often at a loss to the long holder, which is why exchanges favor that path quietly. Standing is the only option that converts a contract into physical obligation. It requires the exchange to assign warranted bars, remove them from registered inventory, and transfer ownership. Standing is the stress test. Now look at what has already occurred before this delivery window even opens. Approximately 50 million ounces have been withdrawn from COMEX vaults in a single month. 50 million ounces removed before First Notice Day even begins. That scale of withdrawal is not routine turnover, it is acceleration. Registered inventory has fallen to between 86 and 88 million ounces. On one recent session, 3.36 million ounces left the registered category in a single day, the largest one-day withdrawal in recent months. The average daily withdrawal rate has climbed to roughly 785,000 ounces per day. At that pace, without any additional March delivery demand at all, registered inventory would reach zero in approximately 112 days. But March is historically one of the largest delivery months on the COMEX calendar. Delivery volumes typically run 3 to 5 times higher than February. If that pattern holds, the withdrawal rate does not remain steady. It increases. Historical context sharpens the picture. In the full year of 2025, COMEX processed 474 million ounces of physical silver deliveries. In 2024, the total was 203 million ounces. Deliveries more than doubled year over year. That is not theory, it is exchange data. Market participants are increasingly choosing metal over paper rollover. That growing demand for physical settlement is colliding with a vault system that has already lost 31% of its total inventory in 4 months. Total COMEX inventory across all categories has declined from 532 million ounces to approximately 365 million ounces. Registered inventory has fallen from around 130 million ounces to roughly 88 million. Eligible inventory, which represents privately owned metal stored in COMEX vaults but not warranted for delivery, has also declined from approximately 342 million ounces to about 278 million ounces. When both registered and eligible categories decline at the same time, it signals metal leaving the vault system entirely, not simply being reclassified. While Western vaults are draining, global signals confirm tightening conditions. Shanghai Gold Exchange silver inventory has collapsed to between 318 and 450 tons, marking a 10-year low and representing a 91% decline from the 2020 peak. The Shanghai Exchange has restricted 23 trading accounts for overpositioning. That is not symbolic. It is direct intervention in response to tightening supply. Shanghai silver is trading at a premium of approximately $10 to $15 above the COMEX spot price. Physical buyers in China are effectively paying near $100 per ounce equivalent, while the paper benchmark in New York remains lower. When two major exchanges on opposite sides of the world report shrinking inventories and widening premiums simultaneously, that is not regional volatility, that is synchronized global stress. Another data point reinforces divergence between paper and physical markets. The United States Mint has released the 2026 American Eagle 1-ounce silver-proof coin at a fixed price of $173. $173 for 1 ounce of silver. That represents approximately a 92% premium over the prevailing spot price. The official mint of the largest economy in the world is pricing its physical silver product at nearly double the paper benchmark. If the spot price fully reflected procurement and fabrication costs, a premium of that magnitude would not be necessary. A 92% divergence signals that physical acquisition costs and paper pricing are no longer aligned. Positioning data adds another layer of tension. Managed Money has added 1,400 contracts to its net long position heading into today. Large speculators are increasing bullish exposure while reducing short positions. Commercial traders, including major bullion banks such as JP Morgan, remain net short approximately 40,000 contracts. That configuration resembles classic squeeze architecture. Speculative capital leaning long into a tightening inventory environment, while commercial entities carry substantial short exposure. Reports indicate JP Morgan controls approximately 40% of registered deliverable silver. 40% of 88 million ounces equals roughly 35 million ounces under concentrated control. If that inventory is released into delivery, it influences settlement stability. If it is withheld, the remaining approximately 53 million ounces must satisfy standing demand against 230 million ounces of March open interest. Today is not about narrative. It is about declared intentions and available ounces. 230 million ounces of March paper claims, 88 million ounces of registered supply, 7.5 paper claims per physical ounce when total exposure is considered, 50 million ounces withdrawn before delivery begins, a vault system losing inventory across both registered and eligible categories, deliveries doubling year over year, Shanghai inventories collapsing, official mint pricing reflecting a 92% premium, concentrated inventory control inside a shrinking registered pool. Today forces a choice: roll forward, close for cash, or stand for metal. The leverage is visible. The inventory is finite. The mechanism will function according to the decisions made. The only variable left is how many choose paper convenience and how many choose physical certainty. The pressure building into today is not confined to warehouse reports or open interest tables. It is visible in funding markets, ETF flows, macro conditions, and the cost of borrowing metal itself. Silver lease rates are currently running near 8% annualized. In normal conditions, lease rates fluctuate between roughly 0.3 and 0.5%. That means borrowing physical silver today costs between 16 and 27 times the historical norm. Lease rates do not rise to those levels randomly. They rise when lendable supply tightens and demand to borrow increases. They rise when physical silver becomes harder to source inside the financial system. Heading into a major delivery window, lease rates at 8% signal stress beneath the surface. Every day lease rates remain elevated increases economic pressure on short sellers. Maintaining short exposure becomes more expensive. Borrowing metal to facilitate delivery becomes costlier. Rising carry costs compress margins. When margins compress, some participants reduce exposure. Reducing short exposure requires buying back contracts. Buying back contracts adds upward price pressure. Higher prices increase mark-to-market stress on remaining shorts. That dynamic creates the potential for feedback loops. No single data point guarantees a squeeze, but elevated lease rates during shrinking inventory conditions establish the structural ingredients. ETF flows provide another confirmation of shifting preference. The iShares Silver Trust, SLV, recently recorded approximately $810 million in single-day inflows. $810 million entering a silver ETF in one session reflects strong capital interest. February holdings overall are up around 2% despite profit-taking earlier, but the deeper signal lies beneath the headline. Over the past week, SLV has experienced outflows totaling approximately 2.13 million ounces. Meanwhile, the Sprott Physical Silver Trust, PSLV, has traded at a noticeable premium to its net asset value. That premium matters. Investors are willing to pay above intrinsic value for exposure backed by allocated physical metal rather than rely solely on paper-backed instruments. Capital is rotating towards structures perceived to hold segregated bullion. This rotation aligns with the delivery trend already observed. In 2024, COMEX processed 203 million ounces of physical silver delivery. In 2025, that number rose to 474 million ounces, more than double. That is not sentiment. It is recorded exchange data. Market participants are increasingly choosing metal rather than perpetually rolling exposure. ETF premiums and vault withdrawals reflect the same behavioral shift. When investors prefer allocated metal and contract holders prefer standing for delivery, the paper leverage structure becomes more sensitive. Macro conditions amplify the backdrop. The dollar index sits near 97.55 and remains within a broader multi-month downtrend. A weaker dollar reduces the effective cost of silver for international buyers. That dynamic increases cross-border demand precisely when Western vault inventories are already declining. Currency weakness often correlates with stronger commodity pricing. When the dollar softens, global buyers gain purchasing power in dollar-denominated assets. The 10-year Treasury yield stands near 4.04%. While nominal yields appear stable, real yields remain constrained by inflationary pressures. A 15% global tariff surcharge has introduced additional cost pressures across supply chains. Tariffs increase import costs and elevate pricing throughout manufacturing systems. At the same time, fourth quarter GDP growth registered at 1.4%. Slowing economic expansion combined with persistent inflation defines stagflation. Historically, stagflation environments support precious metals because investors seek both safety from economic fragility and protection from purchasing power erosion. Silver benefits from both dynamics simultaneously. Today's economic schedule introduces potential catalysts layered directly onto delivery mechanics. Initial jobless claims are expected around 210,000 compared to a prior reading of 26,000. A higher than expected figure would signal labor market softening. Labor weakness reinforces recession risk. Recession risk layered onto inflation supports the stagflation narrative. Safe haven allocation often follows. In addition, Federal Reserve Vice Chair Bowman is scheduled to testify. Any dovish tone, acknowledging economic fragility or signaling caution on rate increases, could weaken the dollar further and support commodities. Monetary tone shifts can accelerate existing trends during sensitive windows. Beyond domestic indicators, geopolitical variables are active. Negotiations between the United States and Iran are taking place while military assets remain deployed in the region. Washington is demanding a halt to uranium enrichment and surrender of approximately 400 kilograms of highly enriched material. Iran is seeking sanctions relief and security guarantees. If talks deteriorate, geopolitical risk premiums expand rapidly. That expansion would intersect directly with the delivery declaration window. Heightened uncertainty tends to drive demand for tangible assets. If negotiations unexpectedly succeed, some risk premium could unwind, producing short-term volatility. Either scenario interacts with contract holder psychology during a mechanically critical moment. The global supply backdrop remains constrained beyond exchange warehouses. The cumulative silver deficit since 2021 approaches 800 million ounces, nearly a full year of global mine production in accumulated shortfall. 70 to 80% of global silver production emerges as a byproduct of lead, zinc, and copper mining. That structural detail limits supply responsiveness. Even if silver prices rise significantly, primary production cannot scale instantly because mine economics are driven primarily by base metals. Production adjustments require capital allocation, permitting, and operational expansion measured in years. Government procurement introduces additional potential demand. Approximately $10 billion has been authorized through the Export-Import Bank for strategic mineral stockpiling, including silver. Strategic purchases do not necessarily announce themselves before execution. Sovereign demand layered onto industrial consumption, ETF allocation, and exchange delivery requirements compounds pressure on registered inventory. Industrial demand remains persistent through electronics manufacturing, renewable energy infrastructure, and technological applications requiring silver's conductivity. That baseline consumption does not pause during delivery cycles. Positioning data reinforces tension. Managed money added 1D400 contracts to net long exposure heading into today. Commercial traders remain net short around 40,000 contracts. Speculative capital is leaning long into tightening conditions. Commercial entities carry hedges that become more expensive if price rises and lease rates remain elevated. Meanwhile, reports indicate JP Morgan controls roughly 40% of registered deliverable silver, approximately 35 million ounces. Concentration of that magnitude within an 88 million ounce registered pool magnifies sensitivity. If concentrated holders facilitate delivery, stability increases. If they limit release, pressure intensifies on the remaining supply. The structural math remains unchanged. 230 million ounces of March open interest, 657 million ounces of total paper exposure across all contracts, 88 million ounces of registered inventory, 7.5 paper claims per physical ounce, 50 million ounces withdrawn before delivery begins, lease rates near 8%, ETF rotation toward physical backing, dollar weakness, slowing growth, persistent inflation, geopolitical risk, supply deficits accumulating, inventory concentration significant. None of these elements individually guarantee disruption. Markets can function under leverage for extended periods as long as rollover behavior dominates, but compression builds when physical preference rises while registered inventory falls. Today's declaration window forces alignment between paper exposure and physical availability. If most participants continue choosing rollover and cash settlement, the system absorbs another cycle. If standing demand exceeds comfort levels, leverage tightens quickly. The variables are visible. The vault balances are published daily. The positioning reports are released weekly. The macro indicators are scheduled. The geopolitical negotiations are public. The only uncertainty lies in human choice. How many contract holders prefer paper convenience, and how many demand metal? That decision determines whether today is routine or pivotal. There is a reason the silver market has functioned for decades despite leverage that appears extreme on paper. Most participants do not stand for delivery. They roll contracts forward or close them for cash settlement. That behavioral pattern preserves liquidity and prevents vault inventories from being tested fully. The exchange has never formally defaulted on a silver delivery obligation. The reputational damage would be enormous. Mechanisms exist to prevent it. Margin requirements can be raised without warning, forcing leveraged longs to liquidate before delivery. Liquidity providers can smooth order flow. Large holders of registered inventory can choose how aggressively to allocate metal. These tools have worked in prior cycles, and they may work again. There is also recent evidence that volatility cuts both directions. Silver traded near 138.40 before declining roughly 36 to 40% in a rapid move lower. That episode demonstrated how quickly speculative positioning can unwind. Geopolitical tensions can ease as fast as they escalate. If negotiations abroad produce a breakthrough, safe haven demand could soften. The dollar could strengthen. Yields could rise. Speculative longs might reduce exposure. Those conditions would relieve immediate delivery pressure. History shows that extreme expectations can resolve without structural breakdown. But none of those counterpoints erase the arithmetic confronting today's declaration window. Even if 90% of March contracts roll forward or close, the remaining 10% represent approximately 23 million ounces of delivery demand. 23 million ounces against a registered inventory base of roughly 88 million ounces that has already been declining at an average of 785,000 ounces per day before delivery acceleration. If 20% of contracts stand, that equals 46 million ounces. 46 million ounces is more than half of the entire registered category in a single delivery month. Those percentages are not extreme hypotheticals. They are moderate deviations from historical rollover dominance during a period when physical preference is visibly increasing. The exchange maintains stability by encouraging rollover behavior. Cash settlement preserves leverage and avoids immediate inventory strain. That model functions as long as confidence remains intact. But delivery data suggests that confidence is evolving. Physical deliveries increased from 203 million ounces in 2024 to 474 million ounces in 2025, more than double year over year. That increase signals behavioral change. Participants who accepted paper settlement in prior cycles and later watched price rise may choose differently next time. Each delivery window where metal demand increases tightens tolerance within the system. Watch 3 specific indicators over the next 72 hours because they reveal whether today remains routine or becomes pivotal. First, monitor March open interest immediately after first notice day declarations finalize. How many contracts remain open? Each remaining contract represents a potential 5,000-ounce claim on registered inventory. A sharp drop in open interest suggests rollover dominance. A stubbornly elevated number indicates meaningful standing demand. Second, observe daily registered inventory changes. A single-day withdrawal exceeding 2 million ounces signals acute stress. Repeated multi-million-ounce withdrawals indicate acceleration. Third, track the Shanghai premium. If it widens beyond $15, physical markets are pricing scarcity more aggressively than paper benchmarks reflect. When global physical premiums expand alongside declining Western vault balances, divergence eventually resolves through price. All reference data originates from publicly available sources. CME warehouse reports publish daily vault balances. Commitment of traders reports outline speculative and commercial positioning. Shanghai Gold Exchange releases inventory statistics. The United States Mint publishes product pricing. The Silver Institute compiles annual delivery and supply figures. The Bureau of Economic Analysis provides GDP data. Federal Reserve calendars list testimony and economic releases. Defense Department publications confirm geopolitical deployments. These numbers are transparent and independently verifiable. Interpretation may differ, but the inputs are not hidden. The structural backdrop remains constant. 230 million ounces of March open interest, 657 million ounces of total paper exposure across all contracts, 88 million ounces of registered deliverable metal, 7.5 paper claims per physical ounce, 50 million ounces withdrawn from vaults before delivery even begins, lease rates near 8%, a cumulative supply deficit approaching 800 million ounces since 2021, Shanghai inventories at decade lows with trading restrictions imposed on 23 accounts. Official mint pricing at $173 per ounce, representing a 92% premium over spot. Approximately 40% of registered silver concentrated under one institutional holder. These figures do not guarantee a crisis, but they compress flexibility. Supply responsiveness remains limited. 70 to 80% of global silver production emerges as a byproduct of base metal mining. Even substantial price increases do not instantly generate proportional new silver supply. Mine expansion requires capital, permitting, and time. Industrial demand continues through electronics manufacturing, renewable energy infrastructure, and technological applications requiring silver's conductivity. That baseline consumption does not disappear during exchange delivery cycles. Government-level procurement authorized for strategic mineral stockpiling remains active and could introduce additional sovereign demand without advance notice. Markets operate on confidence. As long as participants prefer paper efficiency over physical settlement, leverage persists. When preference shifts toward metal, leverage compresses rapidly. Today tests that preference. If rollover behavior dominates once again, the system absorbs another cycle and continues forward. If standing demand exceeds comfort thresholds while inventories remain constrained, pressure builds faster than usual. Run the percentages carefully. 5% standing equals roughly 11.5 million ounces. 10% equals 23 million ounces. 15% equals 34.5 million ounces. 20% equals 46 million ounces. Compare those figures against 88 million ounces of registered supply that is already declining. Add the daily withdrawal pace of approximately 785,000 ounces. Consider March's historical tendency for delivery volumes 3 to 5 times larger than February. The calculation is straightforward. Today is procedural. Contracts either roll, close, or stand. The vault either allocates bars or retains them. Inventory either declines gradually or accelerates. The exchange mechanism functions according to declared intentions. The data updates daily. The leverage remains visible. 230 million ounces of March paper claims, 88 million ounces of registered metal, 7.5 to 1 total paper leverage. A vault system that has lost 31% of total inventory in 4 months. Deliveries that doubled year over year. Lease rates elevated. Global physical premiums widening. Inventory concentration significant. Slowing growth combined with inflationary pressure. These are inputs, not opinions. The outcome depends on participation. How many choose to roll forward? How many close for cash? How many stand for metal? The declarations are filed. The vault balances adjust. And the market responds according to arithmetic. The system has survived prior tests. Whether it remains comfortable under current conditions depends on the percentage that decides paper is not enough.